Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors, and we're here to deliver insights on how current macro trends and market events have changed the value proposition on traditional assets like equities and bonds, the things Bill and I grew up trading, investing, and researching over the last 25, 30 years. Instead, we think it's digital assets that are setting the new financial and investment frontier for investors like you going forward.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So hit the subscribe button on your favorite podcast platform, and let's cut through the noise together.
Welcome to episode 10 of the New Barbarians podcast. Today is Monday, March 3rd, 2025. This podcast will hit the platforms later today. This past week, we said goodbye to legendary actor Gene Hackman, and Mark Connors will discuss his latest blog comparing investors seeking certainty to Jimmy Chitwood from one of our favorite Gene Hackman movies. Last week, tariffs and trade wars dominated the headlines, but yesterday, on Sunday, Trump truthed and retruthed his own truth, which had very interesting implications for the crypto market and wider risk assets. I'm looking at some pre-market equities to see how it impacts markets this week. Mark, take it away, please.
All right. I loved how you went into that truth and retruth. Talking about Trump and Jimmy Chitwood in the same sentence, you know, those two things don't happen too often. Let's start with Trump and the Truth Network, Truth Social. So yes, I wrote a piece over the weekend, and as I'm writing it, obviously Gene Hackman, loved him in Hoosiers. That's what I think I was in college when it came out. And when he passed away, you know, I have a thread with some friends, and we all went around with our favorite Hoosiers quote. And majority of them were "my team's on the floor." And we talk about that when the players fouls out, there's another player on the bench. They only have 6 guys, and the player who's benched for not playing with the with the team's program, his name is Raid. Raid got benched for not passing 4 times before he shot. That was the first principle of the team. So when the ref said, 5th foul, Raid jumps in and Gene Hackman says, "Where are you going? Sit back down." And the ref says, "Coach, you need one more." And Gene Hackman responds, "My team's on the floor," in only the way that he can, with a certainty that the ref said, "All right." And the crowd booed him. But what he was doing here, and this is part of what we're talking about with integrity. What he was doing is he said, "I have a system." And I love that black book that he keeps waving. It reminds me of maybe Satoshi's Code. But he was waving it. And when you do Substacks like this, Bill, you kind of go back to make sure you get things right, because it was a long time, maybe since I saw the movie. And you get more nuances. You notice that in the movie, everyone's yelling at him except for Shooter, the assistant coach, who's, the guy who was an alcoholic, but then Gene Hackman, of course, helped him. And Barbara Hershey in the crowd, who didn't like him, but then said, "Wait a minute, his behavior is a signal." So that's right. And one of the good players, I hear from my assistant in the background, reminding me as we watched the movie over the weekend. So that's basically in the markets. You have to have what we think as an investor is you're going to need that centerboard. You're going to need that clarity that Gene Hackman had, because you're going to draw good people like Jimmy Chitwood. Jimmy Chitwood wasn't playing on the team until he saw the behavior of Hackman. The integrity of saying, "I don't care if the crowd doesn't like me. I don't care if I got 4 guys on the court. I don't even care if I lose the game." He lost the game because he was playing for a bigger one. So again, back to 2 things that happened over the weekend. Recently, obviously Hackman dies. We all revisit his body of work. And the movie's not great, but the message of
Sorry to interrupt. I believe it is great, and I was surprised that it's not ranked higher on the ranking of Gene Hackman movies.
what
I
was it
loved it. I
ranked?
remember seeing that in the theater. I guess, I'm a few years younger than you, so maybe I was more impressionable or something, but I still love that movie. And yeah, the fact that people quote it um, and then put it in their Substack blogs all these years later.
That's a testament, I guess. That does.
Yeah.
So let me roll it back. You're right. And as you said, you just basically, I could tell you got your back up. You're like, wait a minute, Mark. It is great. It is great. What I think about that movie and other movies in the 80s and 90s, from a dramatization standpoint, they don't have the same, pop and and they just look different. But the reason we're still talking about them is because the messaging is archetypal. It's transcendent to time. It's discipline will carry the day, and Little Hickory, beat Central from Ann Arbor, not Ann Arbor. They were in where's Notre Dame?
South Bend.
I think it was South Bend, maybe. But anyway, it was a big city that they beat,
And
and
it's
that's
based on a
why,
true story as well, correct?
right? They call it the Milan Miracle. A town of 165 kids beat in 1954 a school with 1,600 kids in a grade, and they still talk about it. So yeah, I mean, we want that. We want to have that strong leader who plays the long game, who has discipline, who won't bend for the easy hit. All right, so now let's talk about let's talk about True Social for a second. Um, so I'm going to pull something up here because it says two things.
I
Yes,
didn't notice that it was a truth followed by a retruth until you actually showed me. Yeah, I didn't pay attention to much over the weekend, but yeah, I haven't been reading the truths or retruths.
so I've heard about True Social, and over the weekend, as some people who own Bitcoin might do, maybe I looked at the price, and it was popping, and then I went to X/Twitter, looked at some of my people like James Lavish, um, Larry Lepard, and some other folks, and I saw this thing appear, this thread, and I looked for it. I couldn't find it. So on True Social, which is a social network, I had to join on Sunday in order to get the tweet, or what do they call them, a truth,
Truths. Yeah.
truths. So not tweets, because I can't speak to this in my Substack or with my clients unless I get source data. So the fact that the president uses this, it's just genius. I mean, obviously we know the guy knows PR and marketing. I had to go and join up, give him my, I had to get KYC'd in order to get what we're looking at. But the reason I had to do it is it's relevant here, Bill. So I had to pay the price of entry 21 hours ago, because I just clipped this right before our call, which is about right, because it was in the late morning. Trump drops U.S. crypto reserve will elevate this critical industry, et cetera, et cetera. And what does he mention? It'll include XRP, Solana, and ADA, Cardano. And I'll make sure that, we're doing it. And it's in follow-up to his January 23rd executive order, which was, it said over the next 6 months, we'll have a plan. Well, crypto was tanking. He has an event Friday run by David Sachs. And there's no way they wanted to have all the media there for an event coming Friday, talking about their plan for the crypto industry with Bitcoin and everything else down 20, 30%. So I think he did this to buttress it's my opinion, to buttress the market. But look what happened. Look up here. He's like, oh, yeah. Sorry. Yeah. And you know what? We love Bitcoin and ETH. Like, well, I hope so. There's 75% of the market. I hope you love Bitcoin and ETH. Yeah, they're at the heart of the reserve. I also love it. Like, I don't know who put this out, but it wasn't exactly thoughtful, in my opinion, uh, given the Me Too on 75% of the market. So I just wanted to sort of share that on a couple things. That clarity and certainty, I don't think we're going to get it in the markets. We have such a fragmented market, and the benefit is decentralization, is that you can look to different outlets. In the old days, obviously, you had to turn on the news when it was showing at 7 p.m. or whatever, or get the paper when it came out at 7 a.m. We have more outlets now, but the question is, what do you trust? What's credible? And that's why you need Gene Hackman with that black book. You have to find that source that has integrity over time, and that's what we're trying to do here. So I'm putting us up front and center as not arbors of truth, but basically people trying to curate what the hell's going on in the marketplace, bring up data and source information. And I'll land the plane with this. Where are we right now, Bill? There's only one question to ask. How far are we in a sell-off? Yes. How long will it last, and how low will it go? And that's what we talked about. So I don't know if you looked at anything else that caught your eye in my blog on the market side, but those were the two events. Gene Hackman passed, loved it. I agree. Hoosiers should be a little higher. But the sell-off, the reason I linked Jimmy Chitwood to gold is because Chitwood heard the signal, and investors are seeing the signal of gold. So I'm going to stop there for a second before we pivot to more technical, broader matters in the marketplace, away from the character of the type of people that we want to follow. All righty. So I'm going to go hit up something that's in the shadows that I think is relevant to watch here.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
So Bill, here's what we have on markets. So here it is, February 28th, Friday. We went to bed. I forgot when poor, Gene Hackman left us, but I think it was maybe Thursday or Wednesday. So during the week, markets mourned, obviously, big 18% sell-off in Bitcoin on the month. 12% of it came on the week. So we had an acceleration of that sell-off. So in the thing of where are we? We left Friday in a huge sell-off, accelerating. It brought Bitcoin down on the year to date. It put NASDAQ down on the year as well. So equities and Bitcoin down. It brought gold down. There was really a wholesale sell-off, except for bonds. So there was a flight to safety. And when that happens, we get a little concerned, because bonds have not been a flight to safety of late. So that's what the mess is. February was a mess, accelerating into Friday's close. But on a year-to-date basis, you still have those two havens of gold and European equities, something that you mentioned about in your overview as something that really wasn't signaled by many on Wall Street. So the low PE equities in Europe, 13 PE, are up 12%. People are hiding in that higher quality, lower tech, lower beta index, and they were selling the higher beta, higher PE NASDAQ. So that's been on. So the question is, how low? We're down on a 7% peak to trough right now. Last August was 13%. So I think that would be the next stop, barring any type of government intervention or exogenous event. And to take it a step further, and let me go up here on the looking at some of the move index. Well, we're going to have to cut a lot of this out. Okay, switching over to the move index. Everyone, Bill, is looking at equities. Where's Amazon? We're a Mag 7. Equities don't cause contagions. What causes contagions, and we've seen in '08, is when highly levered, low volatility assets fall out of bed, like credit or like the bond market. So here we see this is called the MOVE Index, and it's the VIX of bonds, Treasuries. Just like the VIX, when it goes up, it means there's volatility, there's uncertainty. Over the past week, we saw a spike in the MOVE Index from 86 up to 104. Now, that's not a breakout, but if we see that MOVE Index continue, it means that this $28 trillion cash market, hundreds of trillions of dollars of notional treasuries, it means that the people who own them are hedging and using options on these futures to reduce their risk. It means that they're nervous. So that uncertainty will push this thing up to 140. And it's like we saw when the banks went under in March of 23. And the reason why I think we're in a new regime of volatility is look at this barometer of risk in what should be the safest haven on the planet, U.S. Treasuries. It started to go higher when rates were raising. It blew off until the Fed instituted new programs to support the banks, and it's never resumed back to its pre-rate hike, pre-COVID levels. So that's why we like a system like Bitcoin that is outside of treasuries, that isn't subject to debasement or systemic leverage. People can leverage it, but they'll get blown out, and Bitcoin itself will only have 21 million coins. So it's a little bit different. So that's why we had our Substack focus on Hackman bringing Bitcoin into the court in our little cartoon that we created with ChatGPT. It's because we think more and more people like BlackRock, who Friday announced they're going to put it into their discretionary portfolio, people like Fidelity, people like Louis Bacon, people, well, you can look at Google searches, people are increasing their interest in it, is because it acts differently. And treasuries right now, we think, will continue to have volatility because the government deficit, we think, won't go away. People are getting older. The governments are supporting healthcare needs. So we're kind of in this odd period of high leverage, growing needs from an aging population. And equities are a distraction. You need to look at where the sausage is made, and it's made in debt issuance to support legacy programs like Medicare and Medicaid. So where are we? We're halfway through a modest sell-off or a cyclical sell-off that we see every 6 to 12 months. But we're not going to have a severe sell-off unless you see the MOVE Index spike or you see something in the credit sphere, which I know, given your background at AIG, you're keenly aware about what a centralized, leveraged animal, when things go the wrong way and flows change, what can happen to a market, as I can, being at a hedge fund that had exposure to Lehman. Those are things, Bill, we don't even talk about today. Like, when was the last time you heard people say, where are double B spreads? How are defaults doing? Like, it doesn't hit the news media anymore.
Right. And that's really an indicator of the interest in like high yield credit and going down the rating spectrum. Like you would usually look at low grade junk as a way to gauge interest and risk, and it should definitely we should definitely discuss the fact that it was not really credit risk, but liquidity risk that brought all of the banks down. So, there weren't defaults on contracts that AIG, had to pay out on. It was really just posting collateral and, 33+ billion in collateral posted on unrealized losses. that brought AIG down. And, you can argue the same is true with Lehman and Bear and others, which, I think everyone thought they were hedging, but, the hedges required you to post a lot of collateral. And, we'll definitely cover that extensively in a future podcast. But getting back to your question, the contagion that we worry about is perhaps no longer there, but I would argue it's like moved, it's shifted. And, in particular, I worry about people thinking they have a bunch of liquidity with a wrapper around high yield bonds. So, HYG is a basket of high yield bonds that may become illiquid, with a serious market sell off. And then all of a sudden people won't be able to get out of their ETFs. And, those are probably being borrowed and lent as well. And so unwinding these things is complicated. And I think, for now, we aren't worried about that terrible scenario, but it's gotten more complex. And, last time everyone was worried about CDOs and these opaque things that people didn't understand that had high correlations when no one expected them. I mean, correlations go up when everyone gets freaked out because they sell everything,
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
So, I did have a few other takeaways from your blog, Mark. One was the MOVE index. Another was the CBOE correlation index. I think, generally speaking, quants aren't going to be reactive to a lot of market volatility. And, there could be cases where these different indices or technical data from pricing different instruments can be input into a model, especially in I would argue in the quant macro space, where a lot more of the trading is technical. You're typically going to be trading futures. So, options on futures, the MOVE index, I think would be a very good indicator for trading futures.
And so, Bill, when you're talking about the quants and how volatility, you say interim moves volatility won't change their positioning or their degree of investment in the marketplace?
Right. Good question. So a risk management function for a quant portfolio may take down risk. In a severe drawdown scenario, you might actually start selling, across the portfolio. It's called like a horizontal slice across everything. So you basically just keep the portfolio the same, but then sell some percentage of everything. So of course, from a pure risk management perspective, yes, drawdowns are, significant for the portfolio. Your banks might take down, they may change margin requirements, and typically this will all be understood up front. So, the risk management function of the quant fund may actually have to have, requirements for taking down risk in certain scenarios when volatility is real high, et cetera. But no, typically the view for a stock, assuming it's more than like a couple days or even a day, it won't necessarily change the stock price forecast for a specific stock.
Okay.
And so you still want to hold it if you think it's a good value. You'll still want to sell it if you think it's a bad value. And the volatility of an index in this case, options on futures probably wouldn't have a huge impact. Having said that, these are interesting things to research. So these could be conditioners where like you have an existing model that you think you can enhance with another piece of data. So maybe an index like this would actually say, you know, high dividend yielding stocks, which are, bond proxies, maybe you want more or less of them change depending on the change in one of these indices. But, typically I'm not focused as much on the move index, at least when it comes to equities. Like I said, I think it could be very significant in the macro space, and it may actually be a driver of value. I would expect it to be a driver of value for bond futures.
Got it. So, and is that why some investors go into quant, because they look at the market differently and they won't react to, say, a spike in the move index other than to, as you said, do that slice where they just take a portion of everything and say, let's get lower to ground, which then I think, and you tell me because you're in the space, would it then give rise, if people were slicing and selling everything as if they were the same, wouldn't that give an increased correlation across markets? This is a CBOE correlation matrix that you mentioned earlier.
Yes. So this is great. There are a few things here. One, I think a lot of investors like quants because they don't have the same like panicked behavior. They're not going to sell just because everyone else is selling this week. And, we didn't even get into it, but on Friday, quants probably won't react as much unless it's like a news-based model to, Trump and Zelensky having a disagreement or other things that we saw in the market. But yes, when selling is taking place, especially with the panicked investors, things like this, you expect correlations to go up. When correlations change, outlooks for specific stocks will change a bit. And so this is much closer to the quant process. So, the relative cost of trading securities changes when their correlations go up. The market impact of trading Coke versus Pepsi will presumably go up when correlations go up.
Right. And that's because since there's no distinction, if you're trading two different assets, there's no alpha offset to do that? Or is there another reason why the trading costs would go up?
So cross-market impact and correlations of different stocks mean that, like if there's heavy trading in Coke and the price of trading Coke goes up, the price of trading Pepsi would also go up.
Okay.
To simplify the world a bit, but there are lots of studies in the execution space around trading costs and change it. Like I think if correlations are going up, the cost of trading stocks will go up, because if the cost of one stock trading goes up, the correlation will kind of bleed across instruments, which kind of makes sense in a panic selling scenario.
So looking at this, we have two. If we just say who our audience is, it's two groups. It's who you bring to the market here, which through your research, which is a quant model-based investor with your work at Harmonic, and that's your body of work. That's what you've done. AIG, AQR, Two Sigma, and then there's the fundamental, which is more. Where I came from, where it would be a long short investor, an outright, an RIA looking to, grow their body of work for their clients, trying to keep up with inflation. So there's that high net worth individual who's being managed money. There's the discretionary hedge fund manager, macro or long short. So when you look at what signals in the marketplace, back to are we, will we? Are we in a drawdown and will we go further down? Those are the two questions people want to know. We are in a drawdown. We're halfway through what we've seen in the past 2 years of a kind of a 13%, correction. 10% is a correction. We've hit below that. We're in the middle of it right now. What signals would a quant manager want to look at to say, or do they even look at it, Bill? Will they be a horizontal slice? Do they just follow their models? They don't care if Zelensky talks or if gold goes to 5,000, or if Trump dropped truce over the weekend that drive, crypto up 30%.
Now, there could be a truth social based quantitative strategy. I
Okay.
kind of doubt it, but you know, sorry. I just love saying truth and retruth. So the answer is no. Quants won't typically react to news or things that are happening in the market. In fact, if there's a sell off, certain strategies will buy more, right? Like all of a sudden, cheap stocks look cheaper because people are selling them. Expensive stocks become a little less expensive, and so in an ideal world, when everyone else is panic selling, you're buying, right? You don't need to be panicked. So I think that's the real answer. So if you have a steady outlook and a steady way of trading stocks and thinking about valuations, a sell-off can actually be good for quants. Now, when there are unwinds, and a lot of times you suspect that a fund blows up, and you'll see acceleration of selling, and of course quants look at this, and especially the risk managers, the risk management that's inherent in the portfolio construction process will account for some of this. And then of course you have an independent risk manager who looks at portfolios and market risk on a daily basis. So that's where this more drawdown type of control mechanism kicks in. That would be like an independent risk manager. In fact, the quant who runs the portfolio might be saying, no, this is great buying opportunity. I don't care about what's going on Truth Social. But the independent risk manager might have to step in and say, yeah, but we have to fight for another day. Like
I think that reaction by the PM is across disciplines. It'll be every PM says, wait a minute, I love where I am right now. This is great opportunity,
Yeah, don't sell my book. It's looking better. That it's cheap right now. That doesn't mean it's a good time to sell. It's a terrible time to sell it. And typically that's what you see. You sell when things are going down. And then you have to buy them when they become expensive again. So that's a terrible scenario for the PM. But the risk manager will say, yes, but we get to fight for another day. We're not going to actually blow up. And this is what we told our investors we're going to do in this scenario. Perfect. I hope that answers your question.
Yep. No, it does. It does. So I know we're going to try to wrap up here a little bit, but I thought it'd be worthwhile when you talked about just that last part about, selling, people tend to sell when they shouldn't, and, and buy in sort of a FOMO market. Let's put what happened in the last month in perspective, because the question here is, are we in a sell-off, and will we go lower? Will we? We are in a sell-off. So let's look at the last month. We're looking at gold. Again, that's what our Substack was about. It's about the signal of gold and why investors are going to it. You can't debase it. People think it's, boomer rocks and all that. Say what you will, but it's up 45% in the past year. But look in the last month. It's done what it's supposed to do. NASDAQ risk asset off.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
All right, Bill. Well, I think it's a good way to take what you said about PMs always saying, no, don't take my book away. This is when I want it. The PMs now, we just opened up 9 minutes ago, so we'll drop this shortly. It's Monday. We ended the week with Zelensky not going to lunch, with plates still set for a White House peace treaty or mineral rights exchange that never happened. We went into truce being dropped on Sunday that drove markets. So now where are we? Are we in a drawdown? We absolutely are in a drawdown. Let me share my screen here that shows, or I'm sorry, let me talk about the screen here. Gold has been up on the year over the past 12 months, and obviously during a very volatile period. The other one that's up, obviously, is Treasuries. This is a 7 to 10 year ETF, which includes interest as well as price changes. It's up 2% over a month. You know, it's a nice number annualized. Anytime you see a 7 to 10 year up 2 points in a month, you know that's an accelerating risk off. So as a former chief risk officer at a hedge fund, I can tell you that would be a signal. NASDAQ down, Bitcoin down, and obviously the higher beta, more centralized protocol, Solana and ETH also down. But let's look at what happened over the weekend. They were all going lower. And then Trump dropped that nugget. And look what happened. It all started to rally. It all went higher. And it's recently, traded off a bit. But the point is, crypto markets trade on the weekends. And it's a question on whether or not there's idiosyncratic. And now I'm going to go over on a year-to-date basis. On a year-to-date basis, Bitcoin was flat. Now it's down 2%. It looks like we are reaccelerating to the downside. So markets are open. The brief Trump bump that we got from True Social is not carrying the day in crypto. The broader market pressures are still weighing on markets. So now the part is, again, back to Gene Hackman about the long-term game plan. Can it carry the day? The question is, as we have more debt in markets, speaking again to my cohort, more Bill, about the long-term value proposition of wealth preservation, will the digital assets continue to outperform the NASDAQ gold and bonds over the long run? As you see, obviously up 9 to 10 times, versus up, down for the 10-year bonds, which is fascinating. They're down over the past 5 years. The U.S. Treasury market and gold and obviously equities up. So are we in a sell-off? Yes. As we see with this, 1 month trigger about what's going on here, we're continuing to dive lower. So I'm going to leave people saying, look at the MOVE index, because that'll tell you what's going on, about whether or not there's a contagion. We looked at the CBOE correlation matrix. I would suggest that people kind of get into Mandy Zhu, who is a volatility strategist. I used to work with the Credit Suisse. Now she runs the team over at the CBOE. Get on her distribution, because if there's a contagion, you're going to see it in other assets before it hits equities. So anything on your research that you're doing that you think modelers or quant researchers should be folding into their process?
So I think it's helpful just to look at market color to vet your assumptions a bit. So value stocks were up big last week, and I think that these are just intuitive results. So and they're mainly reflecting market based behavior. It's not necessarily quants that are just buying value stocks. That's what individual fundamental PMs are doing. And then if you have a sector or factor rotation strategy, like these can also be good times to take advantage of these types of moves in the market. And I just read that growth and quality are becoming more correlated, which I think is interesting, because that I think that really just means they're selling off. Like we saw quality doing better heading into this, and maybe those are selling off as well now, and people are getting back into value. So there's risk off behavior in quant space, which I think you can take advantage of if you have like a factor rotation or a factor timing strategy.
Okay.
My previous employer, AQR, I think didn't really believe in any of that kind of stuff. And that was like set it and forget it, much longer term. You of course rebalance and revisit all of the stocks you like and dislike, but you wouldn't actually pivot your strategy typically.
Yeah.
Because, It's really hard to prove and have econometric reasons for these factor rotation strategies or factor timing in particular. So I think those types of things are more in the machine learning space, the non-linear types of strategies. But yeah, these can be great times for models that are meant to take advantage of this type of a situation.
Yep. And so going back to our two different sort of audience members, I can tell you by the rise in the VIX, by the rise in the move, that there's deleveraging going on in the marketplace right now. So that's going on. You called it the slice. It's similar. There may be higher beta names going first at fundamental long short hedge funds. Macro people will not be necessarily deleveraging. They'll be leaning in across different verticals, whether it be rates vol versus equity vol and the like. But going back to Truvius and a guy like Connor Farley, who's over doing digital asset, who was a guest on our we got to get him back on, because this must be like a great opportunity for him, because he's risk managing digital assets, which gave him a great opportunity to trade on a Sunday when the traditional folks, whether his family wanted him to do that or not, I don't know, but where the traditional folks, had to wait until 15 minutes ago to get back in the game. So I think what we're going to, I guess, end this on is we're seeing a merge of digital and traditional happen. We talk about them separately, but we look at the hedge funds are trading the ETFs against futures. We're seeing market makers like Jane Street just all of a sudden have a new revenue stream from redemptions and creates and other services. And it's what we're trying to do on this podcast is bring both of those domains together with the additional overlay of the work you're doing in AI, because you got to be more productive.
Thanks, Mark. And as we were talking about this, it also occurred to me that I'm so focused on equity quant investing that trend following strategies, which are typically in the future space, actually do very well. So managed futures do love sell-offs. Like they're actually they don't love them. There's a inflection point, and then to the extent that it continues down, they'll start selling, and they'll increase their selling with the market. So managed futures, which would also be quant macro types of strategies, do very well in sell-offs. So they're actually good hedges. And so a multi-strategy quant may actually have inherent hedging to this whole market sell-off as well. So we'll have to revisit the whole makeup of these different players and the way that these things might play out as well.
We're going to have another one only on what you mentioned about liquidity and ETFs, because not only is the HYG a liquid wrapper on an illiquid underlying, but now Fidelity and I believe BlackRock are coming out with managed future ETFs, or they're trying to get that through.
Yeah, those have been around for a while too. AQR has a managed future. Sorry, not ETF, mutual fund.
Yeah,
which from a liquidity standpoint is daily liquidity. It's not minutes and seconds. And then once it's an equity instrument, it can be rehypothecated by a broker dealer and lent out. And
yum. Everyone gets paid more. What can go wrong?
Right. The daisy chain of transactions and forever liquidity is always going to be something that scares me, given where I was. Now it's been 17, 18 years, depending on where you were throughout the credit crisis. So on that note, I think you and I both agree that this is not crazy time yet, and we certainly are not panicking or anything like that, but it is good to revisit some of these things, because when everybody forgets, that's when the real bad problems happen. This time is different. And I forget what Chuck Prince was saying heading into the credit crisis. Something
When the
about,
music's on, everyone's going to keep dancing.
yeah, and he
And
kept
that's so
dancing
true.
and shouldn't have. He should have found that musical chair.
Yep. Well, thanks for that. And Bill, where can people reach you on your work at Harmonic Insights?
Thanks. So harmonicinsights.com is sort of a one-stop shop for everything I do, including my research and this podcast. I'm also on Substack and Smart Karma, which is more of an Asian focused independent equity research platform.
Okay, great. And I suggest reading Bill's piece on LLMs. We all have ChatGPT in some form on our phone. We're getting it better. You go over something that's for the layperson and the professional. I think it's excellent. If you want to look at some of my work and find out how Jimmy found the signal in Hickory those so many years ago, please go to Mark R. Connors on Substack. And clients can call me. I have a landing page, riskdimensions.net. And, for some of our work on cross-asset trading and risk mitigation. Thank you.
Thank you.
You bet. Take care, everybody.